Stock market is one of the greatest ways to build wealth. But what if you didn't have much time to actually do research, pick and choose stocks, and then invest in them individually? Well, lucky for you, there is an easy way to get exposure to the stock market passively through the power of exchange traded funds or ETFs. These are the baskets of stocks all captured together into one individual fund, which actually takes the guess game out of the work, really allows you to diversify your investments and easily get exposure to the stock market investing. Well, hello everyone. If you're new to this channel, my name is Mo, and on this channel, Momentum Finance, we post every week videos about investing in the stock market, real estate, as well as crypto investing. In this video, we're going to be talking about 5 high quality exchange traded funds that allows Canadian investors to get exposure to the stock market passively and build wealth over the long term. In fact, these are all the 5 different ETFs that I'm actively currently purchasing and already have built a portfolio of just shy of $400,000. So I've actually put my money where my mouth is and truly demonstrated that why I believe these are amazing funds. And we're going to go through them one by one, review them side by side, and discuss what their underlying holdings are, what their past performance has been, and why we think these are great picks for dividend and growth investors that are looking to invest in the stock market passively. These 5 picks, namely, are listed here on the screen. The first one being XIC or iShares Core Toronto Stock Exchange Capped Composite Index ETF. Through this exchange traded fund, you get a very low fee exposure to pretty much the entire Canadian stock market. VDY is another fund here on our list. It's Vanguard FTSE Canadian High Dividend Yield Index ETF. Here you get exposure to about 50 high dividend paying Canadian stocks. The next one on our list is another Vanguard ETF. It's Vanguard S&P 500 Index ETF. This gives you exposure to the 500 largest US stocks that are part of the S&P Standard & Poor's 500 index. Next, we have another Vanguard fund, Vanguard FTSE Emerging Market All Cap Index ETF. Here you get exposure to the emerging markets, businesses from these emerging markets, such as Brazil, India, and you name it. And lastly, we have iShares Core MSCI East and Far East IMI Index ETF, XEF. It's from the iShares BlackRock. As the name suggests, you're getting exposure to the remaining international markets through this fund. The last trading price for these funds are all shown here under the closing price. We want to do a quick comparison, just a little bit of more insights. I talked to you about, as you notice, most of them are pretty much giving you exposure to large growth businesses. Some of these funds, though, do provide dividends. You do notice that their inception dates goes as far back as 2001. This is for XIC. And the one that is established most recently is indeed the XEF, which goes back to 2013. It's still close to that 10-year mark we are seeing there. In terms of their management fee, the lowest fee belongs to XIC with only an MER, a management expense ratio of 0.05%, and the highest belongs to the V with 0.24% fee here. Still very low considered and in comparison to most of the mutual funds that you're looking at a fee of close to 2 to sometimes even 3%. If you look at the past performance of these funds over the different time horizons, they're highlighted based on their colors. You'd see that in the 1-year return, the best performance belongs to VDY with a return of close to 10%. Following that, we had a return of close to 2%, which is for XIC. From then onwards, the return for the remaining of the ETFs were negative. And this is not surprising because last year the stock market has been, in the past 1 year has been really throughout a lot of the downturns. The market has not done so well. In fact, S&P 500 as a whole, we know that has been down by close to that 20% mark. And that's reflected here as well. As an example, if you look at the Vanguard S&P 500 index in the past 1 year, it's not as down as 20%, but it's down by close to 5%. Next, we have the Vanguard FTSE Emerging Markets. It's down probably the worst by close to 10%. 0.8 or 11%. Now, if you change the time horizon to the past 3 years, let's see what is our best performing. Here, you're starting to see some changes. The VDY is now on top of our list. Second being VDY with a close to that 36.6 or 37%. So VFE is now starting to rise up to the top. Close to that, on the third spot, we have the XIC with a 31.3% return. Our emerging markets ETF, as well as the East and Far East ones, are still far behind. In the past 5 years, that's where you start noticing how VFE is starting to separate itself from the rest of the pack. VFE is showing a massive 72% return. VDY is still high up, but now definitely having some distance from the VFE in terms of its return. Only at we are looking at 54.5, close to 55% return. On the third spot, we have XIC with 48%, and the iShares Core MSCI East and Far East, ticker symbol XEF, as well as ticker symbol VEE. Those are hovering around that 13 or 14% and 6% mark. Definitely lacking far behind the rest. Now, if you look back at the return based on the common inception dates, which goes as far back as the mid-year of 2013, or about 9.5 to 10 years ago, we are noticing how VFE really separates itself out from the rest of the bunch with a massive cumulative return of 296%, only followed by VDY at a return of 135%. Almost like half of that performance is only we are seeing from VDY. So VFE really separates itself out from that growth perspective. Not surprising, because S&P 500 and the US companies have done phenomenal over the past decade. On the third spot, we are seeing the XIC with a return of 118%. Still quite a decent return, but nowhere close to what that of VFE. And then we have return of 92% for XEF, and return of 53% for VEE, or Vanguard FTSE Emerging Markets All Cap Index. We're going to move on and take a look at the additional data related to these funds. For the number of holdings beneath XIC, we are looking at, they're hovering around that 250 different companies. For VDY, we're hovering around that 50. For VFE, as the name suggests, this consists of different US holdings, but in an essence, it actually consists of 500 US companies. For V, it actually, the underlying fund is VWO, but in reality, it has close to exposure to 5,500 companies in the emerging markets. And lastly, for XEF, we are getting exposure to close to that 2,600 different companies. All these funds do pay some sort of level of distributions, and the distributions or dividend distributions are based on different frequencies, with the one most frequent being VDY on a monthly basis. Then we have XIC, we have the VFE, as well as the V on a quarterly basis, and lastly XEF, which is on a semi-annual basis. The highest yield 12 months currently belongs to VDY at 4.15%, and the lowest goes to VFE at only 1.2%. The approach for VFE is really not focused on the dividend distributions, but more so on the growth. And that's how you're seeing it, how they really knocked it out of the park in terms of their overall return. As for additional market data, you can see, for example, what has been their 30-day average volumes, quite decent volumes, their market caps. And if you look at the top 3 holdings for them, for XIC, the largest top holdings belongs to Royal Bank of Canada, Toronto Dominion Bank, and Enbridge. For VDY, you're looking at Royal Bank of Canada, Toronto Dominion Bank, and Enbridge as well. So very similar holdings, but here, because you only have 48 different companies, the weightage is a lot higher. Almost 14% of that fund actually belongs to Royal Bank of Canada investments, whereas in the XIC is only about 6%. As for VFE, it has its underlying funds, mainly VOO, that counts for about that 99.99%, and as well as some index futures. But if you look at the top holdings from a business perspective, you're looking at the likes of Apple, Tesla, and mostly these technology companies that also are on top of the largest companies in the US. As for V, as I indicated, It mainly has its exposure to VWO, but in reality, it has exposure to 5,500 plus companies. And lastly, with the XEF, you're getting that exposure to different underlying holdings as well, but partly through IEFA, as well as some companies such as Nestle and ASML Holdings. In terms of the sector breakdown, you notice that across the board, with the exception of VFE, financial services is the highest exposure you're getting. For VFE, the highest exposure is to technology, with close to 26%, followed by healthcare and then financial services. As for the Canadian businesses, given how energy sector is one of the more important sectors here in Canada, with many companies active in this sector, energy is on the second spot with close to that 17% or 18% for XIC and 27% for VDY. Lastly, if you look at the geographical exposure, you're not going to be surprised that for XIC, pretty much your entire exposure is to Canada. With VDY, very similar. And with VFV, you're getting almost 100%, pretty much 100% of exposure to the US companies. And as for the V, we are getting 100% exposure to other parts of the world. As the name suggests, you're getting exposure to those emerging markets. Whereas for XEF, because it's East and Far East, if you're more specific, you're getting a slight exposure to emerging markets at only 1%, but mainly is the international markets to 60% exposure to Europe, 26% to Asia, 8% to Oceania, and 3.4% scattered throughout the world. There's a very minimal fractional exposure to US as well, as you notice it down there. Now, I talked about my own portfolio, mentioning that I'm also personally invested in these funds. And this consists based on our investments for my wife and myself. We are invested in all of these funds with two additional additions here. One is VEQT, or Vanguard All Equity Index ETF. This is a fund that we have in our Smith Maneuver portfolio, which accounts currently about 22% of this portfolio size. We also have slight few shares of Bank of Nova Scotia, which we plan to sell as soon as it hits that break-even point. In terms of our holdings and their returns, if we look at it, you're noticing that we currently have about 43% of exposure to VDY, followed closely by VEQT and VFE. These three indeed actually account for close to 88% of our holdings, these three funds. This portfolio actually giving us a current market value of $381,689. In terms of the cost basis, we've actually deposited and put money close to $388,000. This portfolio is down by close to $6,700 at this time. This translates to a negative return of 1.7%. Not that terrible, knowing that, again, stock market has not done so well, especially in the last few weeks. And that's when our portfolio kind of reversed. At one point, we were actually positive close to 2% a few weeks ago, and now we're down by about that. And we are using these opportunities as perfect chances to actually pick up more of shares of these funds that we have in our portfolio at lower prices. And that's something that we are going to be continuing to do. Our plan is, as we begin the new year, deposit some funds into our tax-free savings account, kind of max out our positions there, use that funds to buy more shares, and over time, of course, continue to put money into our non-registered accounts as well, and continue to buy more shares of these quality funds that we have. This portfolio currently brings us a total average dividend expected of $10,869. That averages about $906 per month, or average daily of $30 in dividend income. Well, it's nice to get these dividends, on an almost monthly and quarterly basis. We are definitely not just relying on dividend income as the sole way of growth in this portfolio and in terms of wealth building, but also through expectation of the appreciation of the values for these funds through the growth in their price, and the increase in their price, and as the value of our investments grows over time, which gives us that growth, as you saw, for example, from VFE, how it's been doing phenomenally over the past 10 years. Well, I hope you found this video beneficial and you gained something of value from it. If you did, don't forget to smash that like button and subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing, including investing in the stock market, real estate, cryptocurrencies. We also talk about ways to reach financial freedom. Thank you, and I hope to see you all next time.